In the Pacific, the Ring of Fire is very active. The Earth is rumbling. In the financial system, it's really no different. Deep beneath what is visible lies an impending crisis. We could dig into where it's coming from, but instead, we'll build really tall skyscrapers right on top of it. Sounds like a plan. You came here for the truth, so let me unveil that for you. Today we're going to look at the impending crisis that everybody is ignoring. We see all the signs, and yet we turn away. Look away, nothing to see here, folks. Well, you came here for the truth, so that's why I'm going to show you what's really going on. I want to begin by taking a look at the yield curve. Every single time this happens, a recession follows. And you can see that once we make our way to this yield curve inversion, essentially when it hits 0%, you have a very big problem that is ahead. Now, I'm not saying that because the yield curve inverts, we will have a crash. What I'm telling you is that this is typically a leading indicator of a recession. That's all. And based on the chart here, based on the trajectory, it can't be more than a few months. Maybe into early next year. But things can change, certainly. But the way we're looking at it right now, yield curve is going to invert, I'd have to say, at some point in the next 6 months. That's my best guess. But it could still be delayed after that. And it may not be. It might be an anomaly historically. But I'm just showing you what we have to go by, okay? Let's look at this next one, and I think it's even better. Interest rate tightening precedes crisis events. Every single time they increase interest rates, we have a recession. That's a fact. Look at this. You can see, by the way, as I've shown you this many times before, you can see what happens here, that every time it can't get to the higher, the level it was at before. And you can see they already, I don't want to mess it up, but they've already drawn this dotted green line. And so today, what they put us, I had calculated it to be higher, but this regardless is showing us that we're right around that time frame now. So looking at this, I think we should be paying attention to the Fed funds rate. They're also including on here the 10-year Treasury and others. But I want to look at the Fed funds rate. I think that if the LIBOR is still around the next little while, which it presumably will be, that is also very important to be looking at. And it tells us what's going on. That's really all we're doing here. We're trying to see what has happened in the past, use those indicators to then predict what may occur. There can and always will be anomalies in the system, but that could be good and that could be bad. It could delay something, it could make it come out of thin air, who knows? We're not able to determine that until we're looking at it in the history books. But most people don't even look at the history anyway, because this time is different. All right, now looking at this, what I think a lot of people tend to ignore, particularly those in real estate as well as in paper assets, this right here, real S&P 500 total return. So when you factor in inflation, when we do have recessions, oftentimes it takes a long time to recover. Sure, if you calculate it in a nominal way, you tend to look at it a little differently. However, we have to justify this in real terms, because if it takes 20 years, in this case here, 23 years, in this case here, 29 years after 1929, so 29 years to get back to where it was. And I think in real terms, it was something like 25 years. I quoted that in my book. I'm pretty sure it's 25 years, but anyway, 25 or 29 doesn't really matter to me. Ultimately, it doesn't get back to that level. So think about that. Think about that for a second and what that means, okay? So we're looking at this today, and we can see that the markets are, when they encounter these slides, when they encounter these downfalls, we tend to have a long period of time before they can get back to it. Look at the NASDAQ. NASDAQ, I think, took 14 years to get back to its previous high from 2000. Look at Japan. Is it ever going to get that high? Maybe if they hyperinflate the currency. Certainly could. We have a problem here that people are not addressing and that needs to be showed. And I know I'll get a lot of negative comments, and I welcome that. Thank you. This right here, hedge funds have returned 1% year to date. Wow. What's happening here? Global macro hedge funds, 1%. The S&P 500, 8%. All right. So when you look at certain assets, you can see what they've been doing, their performance over the last few years. Clearly, NASDAQ has been the winner over the last, let's say, since 2017, really. It's just been dominating against the other stocks, against, really it's FANG stocks versus everything else for the most part. Okay, so any hedge funds and any pension funds and any of all these that have been really heavily invested in the FANG stocks, they've been performing much better than their counterparts. All right, on the right hand side, popular hedge fund positions have been volatile. That's all it's showing there. Moving on quickly. Technology sector accounts for half of the world's most shorted stocks. So on the top of the list, you're seeing Alibaba. Tesla is also on there, but it's not really necessarily a tech stock as in Amazon, for example, which is here. Apple, Alphabet, Netflix, Microsoft, Facebook, and so on. Okay, so we have all of these at the top of the list. Now, why are they being shorted? Well, clearly they've risen up significantly, so people expect that downturn to occur. But we also have to factor in the central banks. The central banks have been there to support it along the way. They've been buying up the shares all along, ensuring that any dips that occur are filled in by central bank quantitative easing. So that's really what's occurring here. So will they be the first ones to drop? Or, who knows? I mean, it all depends on what the central banks do. I'm not here to say what's going to drop first, how much it's going to drop by, but I do know that these are the ones that are most supported by central banks. Definitely, that is a fact. FANG stocks accounted for nearly half of the NASDAQ composite's rally. Wow. Now think about that. Just these 4 stocks, 5 stocks. If it's including Facebook on here. I mean, I'm seeing Netflix, Alphabet, Apple, and Amazon, and they're suggesting FANG stocks. But anyway, regardless, Facebook's contribution amounts to less than half a point drag. Okay, remember what happened a little while ago with Facebook. Now look at this here. So you see it, half. Just 4 stocks, 5 stocks, and then you have to figure what's going on with the rest of the NASDAQ. We're talking about technology here. We're talking about stocks that may be correlated, but they're not necessarily being bought up by the central banks. That's the key. And so the central banks act first. The hedge funds, the institutional funds, they start getting behind them, and then the retail investor is last to the party. But you might be thinking to yourself, this time is different. You might be thinking to yourself, the central banks will be there to backstop any losses. Well, let's take a look back in the pages of history. If you're still here at this point in the video, you probably want to know this information. If you're already gone, see you later. Now, in an interview in July 2005, in response to a question about a potential housing bubble and possible recession, Chairman Bernanke responded, "Well, I guess I don't buy your premise. It's pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis." And then he got smacked in the face. January 2008, 1 month after the recession officially started, the Federal Reserve is not currently forecasting a recession. Then Paulson, who we know, if my memory serves me correctly, he got himself a nice $200 million tax break during this time frame. The economy is fundamentally strong, diverse, and resilient. And then it goes on. Are they stupid, or are they there to calm you down? You tell me. All of these individuals, all the way through, they're tracking it. They have all the insider details. They know exactly what's going on. And yet, they can't even see it after it happened. I think in the next comment here, the Treasury Secretary basically said, we're almost over the recession, basically, to paraphrase. We're almost done. And it wasn't even halfway done at that point. They're never right. Or are they covering something up? We never know. We never know until it's after it's done, and we can basically read about it as history. But everybody seems to know everything. So you tell me. And quickly, two little things. The core PCE, the Fed's favorite garbage statistic, has now hit that 2% year-over-year mark. So even their fake garbage way of calculating inflation has hit 2%. My goodness, finally. Finally. It's actually significantly higher than that, but whatever, who cares? And pending home sales declining. I should have put this in my previous video with the real estate, but I just wanted to mention that to you because by the time I can get to another one on this, it might be a little while. So pending home sales are down significantly in the US, a trend that's been going on throughout 2016 and onward here. So I just wanted to show you that as well. If you found the video informative, please give me a thumbs up. Last but not least, if you found the video informative, I know you're going to find my books even more informative, okay? So this is the financial education you were not taught in schools, and you can check them out at the link in the description of the video. If you're more interested in the audiobook version, you can get that at themoneygps.com.